Good afternoon. This session is called Hedging Europe, and I'm joined by a distinguished group of panelists. To my far left, I have two investors. We have Davide Serra, founding and managing partner at Algebris Investments, and George Papamarkakis, managing partner and CIO at North Asset Management. And to my immediate left, David Hauner, head of EMEA Fixed Income Strategy and Economics at Bank of America Merrill Lynch Global Research. I want to start with the investors. The European crisis has been dominating headlines for the past 2 years. How have you navigated the crisis, and how are you positioned now? Davide?
I think we have navigated badly because we mainly invest in financials till basically the decision of the central bank to step in and do its own function. So when the central bank number one mandate is to keep the system liquid against proper collateral. In Europe, because of politic hearing, they decided for 3 months that there was no risk-free. So no one knew what the risk-free was. In such a situation, you have the old banking system cannot operate, because basically a bank is nothing else but, let's say, like an electricity company, takes electricity and distributes it retail. Suddenly they cannot generate electricity, you have no more lights. In a bank, they get liquidity of a central bank, and they lend it, and they make a spread out of it. And till when finally the central bank had a change of leadership, they read the mandate, which has price stability. Price stability means that when house prices are down 20, bonds down 15, they had 6 different yield curves, short end and long end. It doesn't look like they're fulfilling the mandate. So suddenly they decided to work all aggressively in December, and they came up with the LTRO, which is something the Fed had already been done 2 years ago. So suddenly the system has changed. So we think next year, or for this year, the best way to make money in Europe is to invest in credit in financials. So in those financial companies which are GCFI, or considered globally important, systemically important financial institution, so the national champion per large country. Secondly, in the credit component, so above equity. And the reason is because that's where politicians cannot do the bankers bashing, which they do at the equity level, at the employee level. But at the end of the day, they have these institutions which are almost as big as country. It's the arm under which they execute monetary transmission. And right now you're paid between 7 and 8 times faster than owning the risk-free in the very similar country. So we think for almost similar risk, you get paid 8 times faster. And so we think it's a very good opportunity to invest in Europe. Position is extreme. Last year, if you had a European accent and you presented yourself in the US, people will kick you out. Yeah, just want to know. And if you look at the overall number in Europe, any way you want to look at it, European banks, as percentage of total assets, have less than 4% in government bond holding. In the US, adding study and friendly, you should, it's 12. China, Japan, India, you name it, 30. So here it's very simple. In Europe, we need to decide we cannot compete as the number 2 European bloc, looking at basically competitors that use monetary policy in a totally different way than we do. And so ultimately I think this is clear now. The politics is behind. Everybody has an election in France this year and Germany next year. So they can play with the tools, but ultimately reality is here. The economy has to be held together. And so I think going long Europe, getting paid 8, 9 times faster in GCFI matters. The second point I'll make, I know it's not politically correct, but Europe for me it's 5 countries. The rest it's a bunch of satellites. And Greece has been proven. So you have a default, 70 cents on a dollar, total political disaster in how you get there. So it's, in my view, 3-4 times worse than Lehman, because it went from AAA to default in 2 months. Here for Greece is 2 years disaster, yeah? Tragedy. And ultimately, nobody cares. So you see what happened in Europe was the decision of holding the core together that actually matters from an economic perspective. Mm-hmm. And hence, I think that political decision has been taken. The action in the ECB, in my view, have been fantastic. And they have done exactly what the Fed did. And going forward, in my view, they'll be happy to do more if needed. And as soon as that happens, I think Europe is in a great trajectory.
George, you're less optimistic.
Oh, well, I mean, we had a good year last year, and it was very good because I think we weren't really stuck in terms of a ideological position as to what should be done, but it was very much focusing on what policymakers would ultimately do and how markets would have to effectively, unfortunately, force them right at the last minute to make them move. And I think to a certain extent, although we've seen a lot of action, the LTRO undoubtedly is a very large step and underpins the banking system for the next 3 years. I still think we have a huge issue in front of us in the sense that we've got Portugal trading at 50 cents on the dollar. They're supposed to tap the market next year. Obviously, that's not going to be possible. And everybody's still focusing on Spain, and really that leads to the elephant in the room, which is France. The French banking system still is exceptionally exposed to the periphery. France is not really undertaking any substantial reforms, and we have a significantly left-of-center candidate who's ahead in the polls and doesn't seem intent on taking any reforms. So I think in terms of the European crisis, the ultimate result is really very difficult to predict, whether we're going to go with some type of a common issuance or that we're going to have countries go out. But in my opinion, you're still going to see a lot of volatility. And that's what saved us last year. And I think that's another great source of revenues for us, or return for us this year as well.
And so how are you positioned to take advantage of that?
We're long volatility, both in foreign exchange and also in interest rates. We also have certain longs and shorts within the European sovereign space. And also, I think the most important thing is we're very, very conscientious of managing our position with a very tight stop loss.
David, as a strategist, what do you see as the biggest risks facing Europe?
Well, I think the biggest risks right now are threefold. First, US, second, oil, and third, what I would call impatience, which is probably the biggest risk, the biggest vice. Starting with the US, at the moment we have an increasing wave of optimism, of course. Our view as a house is very much more conservative. We do think that there will be a very significant amount of fiscal tightening in the US next year. This tightening has been legislated already. It amounts to 4.5% of GDP. It could only be removed if there were a very significant improvement in the relationships between the two leading parties in the US to get all of this tightening legislated away after the elections. We think that even in the most optimistic scenario, it is very hard to believe that there will be less than at least 2 percentage points of GDP in tightening. And that means that we expect next year US GDP to grow by 1.5%. So to the extent that Europe has benefited a lot from improved global sentiment, which clearly has been very much driven from the US is a risk factor. The second factor is oil. We think that despite the reassuring comments that we had just yet from Saudi Arabia, we do think the oil market is very tight, and that it can take the slightest disruption in supply will result in a significant further increase in oil prices. Now we know that, of course, especially the peripheral countries in Europe are very susceptible to high oil prices because they're relatively energy-intensive economies. And the last thing the European economy needs is an oil shock. So insofar as we do think that at some point this year oil is likely going to go to 140, we are very concerned about this risk. And this even leaves aside the potential risk of further confrontation in the Middle East. Third, and that's most important, the risk of impatience. What I mean by impatience is that the current policy setup which has been chosen to get out of this crisis is inherently unstable. You have used the LTRO to basically buy sovereign debt through the banking system. This works only, as we see in in Portugal. This works only if there is a presumption that the sovereigns are solvent. If you look at debt projections going forward, even in the most optimistic case, it is very unlikely that the big sovereigns are going to be able to reduce the sovereign debt over the next few years. And in fact, the example of Spain, the example of the UK, which actually has a flexible exchange rate, shows how difficult it is to reduce the level of deficit in an economy which is in a deleveraging cycle. So it can take the smallest shock to, again, focus the markets. And the fact that Spain is widening now quite rapidly, again, shows that impatience, both on the investors' part, but also on the politicians' part, is a key risk because we will need years and years of patience, both on the investors' part as well as on the population side, to maintain the current policy approach. So, well, what does it mean in terms of investments? I couldn't agree more with George that the one thing that you need to be doing these days is to buy volatility, because it is ridiculously low considering all the risks that are out there. It's very hard to time when exactly there will be another round of major market disruption. I do agree with all the risks that have been mentioned on Greece, Portugal, France. It's very hard to say whether it will be really the source of disruption, insofar as it will very much depend on whether the U.S. will continue to grow very nicely, which might overshadow some of these risks. But it is very clear that at some point there will be, again, a very significant rise in volatility.
I'd just like to follow up on what he said, which I think is, you're right, investors need to be patient. I think the problem as an investor that we face is that we don't have the ability to have patience when effectively we've had policymakers. You had Trichet last year saying no European sovereign defaults, and Greece defaulted. So we have a consistent U-turn by policymakers, which obviously then leads to an investor saying, well, I don't want to be part of this market. So I think that's a fundamental problem over and beyond the fact that you touched, which is that these structural deficits, especially in Spain and in Portugal and in the UK, but since we're talking about Europe, are huge. And you need a very long time. And it's politicians which have actually forced investors by taking those actions out of the market.
So what would you like to see from policymakers? What would give you
confidence? I was attending another conference, a Bloomberg conference in December, and I kind of repeated, there's really one thing you need. You need a true lender of last resort, which means that you're going to have which is not necessarily something I'm advocating, because I think that is financial repression, but you need a true lender of last resort like you have in the U.S. So they would buy every single bond that Spain, Portugal issues. Or you need to come with some type of common issuance. We're not at the point now where Spain, whatever reform Spain does, nobody's really cares, because these are reforms which are going to take many years to pay any dividends. You need to have an exceptional cheapening of the labor market, and you need to have a reorientation of the economy per se. I mean, Spain was very much focused towards has a very large exposure to the property sector, so it needs to reinvent itself, and that takes many, many years. So in the meantime, you need that lender of last resort, or you need a common bond.
I share this view that you need a lender of last resort, and I think Mario Draghi's action to read the ECB mandate and to say, I'm the lender of last resort to the financial sector no matter what, which is what he did, I think it's impressive. Secondly, in Davos, he made very clear, if needed, he's happy to do it 2, 3, 4, 5 times more, and at any more extension maturity. The ECB has proven in the liquidity measure ahead of the Fed up to the last 3-4 months, which were indeed a truly political crisis. So the numbers have always been weak, but that's how the European contract worked. I think what is interesting in my view is the following. So take, might sound wrong, but Greece, at the end of the day, net investor loss is 120 billion euro. The rest now, 70% is owned by the public sector, so that will be washed out with some form of printing. What is left in the hands of the private sector, it's tiny, 30, 40 billion euro. Portugal, it's 110 billion. Let's assume you need to take a 20, 30% hit. Okay, now the 20, 30 billion. So you write zero private sector in Greece is 40 billion. You put another 20, 30 for Portugal. If you want to take a 20, so 70. Ireland on its way out. On a GDP of 15 trillion, do you think someone will fuck it up, sorry my English, for a 50 bips point position? And I think the total change has been, Merkel has election, Sarkozy's election this year, and next year it's Merkel. That's at the end of the day who runs it. The big change in my view has been you had someone like, at the end of the day, politics is equal people. You had someone like Draghi that came in and says, if I'm responsible, that's what we do. Secondly, you had the biggest risk in terms of absolute size public debt, Italy. You had a technical government that in 180 days has done more than the previous government in 20 years, and has the highest rating of approval in Europe, hitting its own people. So I think that's very bullish. And last but not least, you take the equity in the financial system in Europe alone, it's 3.5 trillion. It should earn a 10% cost of equity return. So make it 300, ballpark 300 to 400 billion euro of earnings per year. Market consensus forecast is it will earn 100, 150 billion max. So the financial repression will go through banks and insurance earning less money through either rates or imposition liquidity. And this 150 to 200 billion a year can buy over 2-3 years, lots of mistakes. Certainly they can buy Portugal, Greece to zero private, Portugal 25 cents, if there is the political will to accept it. The key risk is in how you get there. If you start having the doubt the euro, the currency across the country are worth a lot differently. Then at that point you create bank runs, and that's why I think the fact that no banks needs financing for 2 years at least allows the time to the politician to fix it. 2 years is a lot of time. Secondly, the decision of ECB to extend collateral in liquidity term at any point in time has shown that as you set up a rule, at the end of the rule, a rule is set up by a human being, so the rule can be changed by a human being. And that to me is very important because were we to face another wall, they have shown they're ready to go. Saving Greece, I think it's a massive political decision. It's impossible to save this guy. This guy were hiring public sector employees over the last 2 years. Basically, they couldn't get a damn. In my view, Greece was part of the euro for geopolitical reasons. Yet the Balkan War was in between an Eastern European bloc, in between North Africa. It's not the place that you would, send your kids to study. So at the end of the day, euro decided to have him in as a geopolitical anchor. The cost is paid, probably saves war. And if you go back, the leader that set up Europe today, in Europe we destroyed the real infrastructure and the human capital infrastructure twice over the last 100 years. That's why the GDP growth and wealth versus the US has been destroyed. So probably the cost of 200 to 300 billion euro on a 15 trillion, now they've seen what it could mean. I think the chances that they get it, it's high. I wouldn't be so bearish. It's too easy to be bearish now.
I want to go back to George's point.
Yeah. First of all, it's not easy to be bearish because we've seen the biggest rally of the last 2 years happen in the last 2 months. So actually, the markets are pretty high. But those numbers are not exactly correct, not only because, A, you're assuming the aggregate banking sector in Europe is homogeneous, which it's not. I mean, there's a big difference between where the exposures lie, and clearly the exposures lie from France down and down. And the biggest thing is we're not talking about Spain, and we're not talking about the fact that we're still in Spain running at best. If they're lucky, they're going to get a 6% budget deficit this year. So the debt dynamics are continuing to be out of control, and part and parcel of that, of course, is the financing rate that they're paying. If they were paying 1%, the ECB rate, obviously the debt dynamics would be much different. But the growth composition, and again, the financing still haven't been addressed. So I don't think the politicians so far, I strongly disagree actually that there's any type of unanimity in terms of supporting or in terms of constructively dealing with this issue. The fact that you have the Bundesbank, and I think rightly so, saying, well, we have a $500 billion exposure right now to the rest of Europe, credit exposure through Target 2. That is a substantial issue, which is clearly talked about in Germany. So there isn't, I don't think there's a consensus there. I think we're going to see the same crisis to crisis, and then ultimately, where it leads to commonality or more LTRO remains to be seen. But they're going to do something only when they get pushed.
Is Greece an isolated restructuring, or do you see more?
I think Greece is unique, and I agree with David to say it's a unique situation. It's kind of think of something bad and multiply it many times in terms of the structural issues there. But that doesn't mean that the issues in Portugal and in Spain, again, in terms of debt dynamics, are not very bad. So yes, I mean, Greece is very unique.
On Greece, one of the biggest stories of the week was the settlement of Greek CDS. And as you mentioned, politicians had said there could be no default, no credit event, and we had a seemingly smooth settlement this week. Were they overly concerned, or did we just get lucky? Are there issues with CDS as a hedging instrument for you as investors that you're concerned about?
Well, we've talked about this before. I think that the CDS market is imperfect because you don't have a huge participation of various, if you like, economic agents, which would ultimately reflect a more realistic price. It doesn't necessarily reflect where a sovereign is truly financing itself. It's very much driven by supply and demand. So I think it's got, in terms of a tool, it's a bit crude to use for an investor. But in terms of did it settle correctly, it did settle. The fact that you could deliver the restructured bonds was a benefit to many of the people who bought the CDS market. I think it will continue. But I don't think it's the most important thing for politicians to be worried about. And in fact, I think what they meant was when they said we don't want to default, is what we realize is we don't want to default for the ECB and we don't want to default on our own public's funds, which raises a whole issue of law and investor rights and all these issues, which again tells you why should you be investing in the local law bond.
Right.
If I may interject, actually, I strongly disagree with that point, which now seems to become a consensus that it was a non-event. I think it was just an extremely well publicized event. Everyone knew it was coming. Everyone had 1 to 2 years to prepare for the event. First. Secondly, the authorities prepared the event very well. I mean, the LCO was part of the preparation process. And then finally, at the end of the day, the outstanding amount was relatively small. So it doesn't mean that if we get, let's say, a deterioration conditions in Spain or France, that would be that would be going as smoothly.
Mm-hmm. And has Greece's restructuring changed the way you look at other investments? Are you less willing, for example, to buy domestic law bonds?
No doubt about it. I mean, I think anybody who thinks that you're buying a domestic law bond and you're pari passu with an English law bond is just not, just hasn't seen what's happened over the last few weeks. So.
My view is I don't care about the law because there's been UK law, US law. I don't care. See what happened in Chrysler. They took the law and threw it in the garbage bin, and that was the president itself that decided to do it. So the reality is, if you look at the numbers and the numbers are there, then it becomes investable. I think in Europe you had a couple of situations. One, which is desperate cases, basket cases, with massive political problems, because the fact that they set up the stability pact, and then Germany and France were the first two to break the stability pact themselves, was basically a major sin. So they were the good guys. They screw up the rules. So they were the teacher that says, kids, go and play. Then suddenly everybody else started playing. They couldn't get the system back up. So that was a major fault. Secondly, today, ultimately, I think will have to be, it's a chicken and egg game, because if there is a breakup in Europe, every smart economist calculates up to 10 to 20% of GDP. That's massive depression, yeah? And I want to see who has the guts of saying, yes, I want a depression, and go and talk there. Third, it's obvious that the net beneficiary out of all the euro integration, as of any economist, has been Germany, because it's been running with euro 20% undervalued versus their competitiveness, where the Bundesbank would have liked it to be. So they keep on winning, and clearly within their clients are not as good creditors. Let's say like a subprime borrower in America, 50% of Americans are now FICO below 660, so half Americans in theory are subprime. Well, they're the one buying the stuff for the growth. And hence, I think the system holds, and it works, if there is liquidity that the central bank now has decided to give. And hence, I agree we'll have bumps. The issue is, would you have bumps where a French guy has to be worried if its euro is worth equal to a German euro? I think that one, in my view, has receded. If it's worth 1% more or less, who cares? The big difference is if you start having capital flow because of safety. That would be my fear.
Do you have contingency plans, though, for the possibility of a euro breakup?
Just on that issue of CDS, I think it's important to note, because we talked about politicians and how it was a success. I think actually that's a big problem. If all of a sudden politicians are thinking, oh, this Greek restructuring was a great success, why don't we try it on in Portugal? And then that just is going to again, accelerate, I think, the domino effect. I think that's where we are right now, where politicians think that we can actually default on a country, it can go down smoothly without taking into account the cumulative effect. This Greece situation, no matter how you cut it, means that the private sector is in a worse situation, and in particular the banking sector in terms of losses. And the same will happen with Portugal. These LTROs should be stressed that effectively you're increasing the risk of the Spanish banking sector should actually Spanish banks not default, should Spanish bonds, not the government default, but actually just the price start moving against it, which means that it needs to post more collateral. So you're actually increasing the risk with all these LTROs. And you know, so I'm not sure politicians appreciate, you know, the Pandora's box to a certain extent that they've opened with this Greece default. And in terms of your question was, you know, what we're doing. I think I'll just go back and I'll be very quickly and leave it for. I think again, you have to be nimble. You have to be non-ideologically committed in terms of what the end game will be, and you have to be long ball.
And just quickly, we're running out of time. What are some of the lessons from emerging market crises that investors can take away here?
Yeah, that's a topic that we did have a lot of work on, because indeed emerging market currency crisis can provide numerous lessons. I would just pick two which I think are particularly interesting. One is the political economy, as we economists call it, of devaluations. I mean, devaluations are typically, they are part of the political process. And at the end of the day, it's while devaluations typically look like there's some sort of accident, there is, in most cases, there's a rational decision, right? Because the country can decide to what extent it wants to defend the currency and how long. But there's a distributional issue here. So basically, what it boils down to, when you look at the history of emerging markets, is that that it is a matter of how high is unemployment and how high are financial assets of households. And when you look at these variables within the periphery, then you come to the conclusion there's one country that could potentially, from that perspective, decide to devalue, i.e., that would be Greece. But for the rest of them, the fact that household financial assets, which would significantly be devalued by such a move, are very, very substantive, argues strongly, from a political perspective, strongly against such a move. The other lesson is really that if you do devalue, then you still need to maintain austerity. Because otherwise, you run loose fiscal and monetary policies, then very quickly in the past, and that was not the case only in emerging markets, but also indeed in the Mediterranean countries that in the past had a number of devaluations, the competitiveness gain disappears very fast. So in other words, let's say, again, picking the specific Greek example, if Greece wanted to leave the Eurozone, then it would still have to run tight policies, and beyond the fact that it would still very likely need an IMF program. So you would basically, you would front load even more pain for a dubious long-term gain, and thus, we would think that it would almost amount to a completely irrational political accident for the country to decide to exit the Eurozone.
Let's just see if we have a question from the floor for this particular panel. Don't see a hand. I've got one quick one there. I don't see how this movie ends well with Greece. The numbers don't seem to work. They can't meet the targets. If they continue to fail to meet the targets, why would Germany continue to write the check? And why will you not end up in the situation where Germany effectively says to Greece, somehow, we will maneuver you out of our common currency union? Unless you think Greece can make the targets. Or that Germany is willing to pay checks to someone who isn't doing what they said they would do.
But what exactly do you gain if they go out of the euro?
You win the election as Angela Merkel the year after next.
All right, okay. So you're not getting your money back. You're just winning, short-term political.
I think I take the opposite view. If you break the monetary contract, you create a massive depression because you have immediately capital flows without the euro that you can't contain. So you cannot be a net exporter bringing your German public debt to GDP. If it were to properly account KfW, it's 115% of public debt to GDP. These are the numbers. Now, France, Cassa Deposito e Consignazione is fully consolidated, and Cassa Deposito e Prestiti in Italy is fully consolidated. So accounting gimmicks as a German public debt is low. That's not true. Apple to apple is almost identical. So the reality is you have three trading counterparts, which are the core, and the idea that you can immediately, by letting 9 million people, which have no borders with the rest of the euro, infect the core, it's mad. At the end of the day, it will be a pure economic decision. And Greece, de facto, has the fact that they have 7 people declaring more than €1 million, and they have the highest percentage of Porsche, Cayenne, per capita. The fact that only in the banking system, on their own annual reports, they had 21 people declaring more than €1 million. To me, Greece is not a state. It's a bunch of crooks that doesn't declare on their own law. So if they don't want to execute the law, there's nothing you can do. That's already a failed state per se. So then, eventually, it will be up to the young people, which are getting fed up, because the young guys, in Greece, they couldn't steal any money. They just were born 20 years ago, and now they're left with a package. And so eventually what will happen is the old generation that has stolen the money and made these trade unions, more protected than the gods used to be, they're going to kick the hell out of the old till when they get the fair share. And hence, I think, for the remaining private debt outstanding, which is 30-40 billion euro, you don't want to create the idea that euros are worth a lot differently inside the eurozone. And hence, I think it's much, and if you see the polls in Germany, the SPD, the socialist, wants the Eurobonds, yeah? And it's more likely that you go towards keeping euro together in the economy rather than saying you're not good enough and then the next year you get a -5 GDP, where everybody loses. But in my view, at the end, that's probably going to be the most rational decision. You might have some drama, it will be a nightmare, you'll have volatility. 3 years from now, you do a new conference, am I going to get peseta, lira, and French francs? I think chances are, probably 99% no.
Yeah, I can just underscore all of these points. We just add that the expected return for Germany of removing a small country from the Eurozone, I think is very significantly negative. Because what you save is some amount of transfer, but what you can potentially put at risk is the existence of the Eurozone, because it's very clear that, as George mentioned earlier, the moment where you open the Pandora's box, which is basically that this is one currency, you are going to get massive deposit flight in Portugal, and depending on where the fiscal consolidation stands at that point, also potentially in Italy, Greece, Ireland, or Spain.
So you can quarantine PSI, but you can't quarantine Euro exit.
It would take the whole crisis to a next level, which is going to be even harder to contain because no bailout in the world will probably bring back that confidence which is necessary for people to keep their own currency in their local bank. You're gonna get very significant deposit outflows, as you saw it, by the way, also in Italy and in Portugal during some periods of this crisis. It happened very quickly. Confidence was restored, but if you do open the Pandora's box of potentially removing some countries from the currency area, then it's going to be very, very, very hard to prevent this deposit flight. And the one other thing I would add is that while Germany might save a little bit in terms of transfers, let's bear in mind that German exports to the rest of Europe are still 30% of GDP. We're talking a lot about more exports to China, but the truth is that the largest export market is still the European Union. So very clearly, Germany would face very significant costs in terms of wealth if it basically pulled out the rug under the continent. And third, of course, Germany would also lose very substantial amounts of financial assets insofar as countries that leave the Eurozone will probably face a wave of private sector default as well. So I think, again, it's about, to the extent that politicians tend to have a very high discount rate, so i.e. They value near-term gains much higher than future gains, I think it would almost amount to an irrational political accident to take such a decision.
So we've run over. Join me in thanking the panel.